Welcome to the deep dive. If you're in the world of sophisticated real estate investment, you you definitely know the ultimate challenge isn't really just acquiring the asset. It's the exit, right? You might be sitting on these massive, well, theoretical paper gains,
Right, on paper.
but how do you actually convert that to liquid, spendable wealth? Our sources for this deep dive suggest that relying solely on the traditional outright sale in, say, 2025, well, it's fundamentally inefficient, maybe even archaic.
That simple sale inefficiency, that's exactly what we're targeting today. Look, a successful exit plan, that's really the ultimate measure of investment success.
Okay.
It defines how you realize that value. And the focus has to be not just on the sales price, but on maximizing your net returns.
What you actually keep.
Precisely, what you keep. And crucially, preserving capital so you can immediately reinvest without friction.
So our mission today is to give you a shortcut, really, into the full spectrum of these liquidity strategies, moving you beyond just the simple listing process. We're going to cover, well, everything, from the tactical use of debt restructuring like refinancing, all the way up to advanced securitization techniques, things like institutional REITs and the really cutting-edge digital frontier of tokenization.
Okay, so let's unpack this foundational concept first because it's really central to all our sources. The decision on the optimal exit path. It has to be modeled and decided right at the point of acquisition.
Not later on.
No. If you treat the exit as an afterthought, you just sacrifice efficiency, plain and simple. But if you plan it from day one, you transform your property into what the sources are calling a programmable asset.
Programmable asset, I like that.
Yeah, it's an asset engineered from the start for maximum tax advantage and efficient liquidity extraction.
Okay, that concept of programmable asset, that's a great hook. So let's start with how we program the asset for tax efficiency using maybe a classic but now highly strategic tool, refinancing, Refi. We need to stop viewing Refi simply as, debt restructuring. It's framed in our source material as this powerful capital recycling mechanism.
And what's fascinating here is how the mechanism actually works with value creation. Refi is typically used after you've successfully forced appreciation.
Right, you've done the work.
Exactly. Say, through significant value-add improvements, which is, the rehab phase familiar to anyone using the BRRRR method, you rehab, you increase the value.
And then you refi.
Then you refinance the property at its new, higher valuation to extract that newly created equity.
And the magic really is the tax treatment, isn't it?
Yeah.
For the learner listening, why is extracting capital via a refinance so much better than just selling?
Precisely. Because under current IRS guidelines, the capital you extract through this strategic refi, it's essentially a tax-free distribution.
Tax-free.
Think of it more like a deferred loan against the asset's value rather than, say, taxable income or capital gain.
Wow.
And this is key. It allows you to retain ownership of the income-producing asset.
Keep the cash flow coming.
Keep the cash flow, continue benefiting from that, and immediately redeploy that extracted capital into a new venture, all without triggering an immediate capital gains tax event.
Wow. So, okay, the investor who just spent maybe 6 months renovating their duplex, they get to immediately pull out that value, that hard work, tax-free, and roll it into the next project. That's a really tangible, immediate reward. So when should you choose this strategy over a traditional sale? What are the conditions?
Well, it's ideal when several conditions kind of align. First, maybe when market-driven appreciation is strong, but you have a desire for a long-term hold.
Generational wealth, maybe?
Perhaps building generational wealth, exactly, and you don't want to sacrifice the asset itself. Second, when you specifically seek a liquidity, but you need to maintain your overall portfolio scale. You don't want to shrink.
Right, you want the cash, but not fewer doors.
Exactly. And third, strategically, when the goal is actually to increase the cash-on-cash return by, efficiently reducing the amount of your personal equity remaining in that asset. It's really all about leverage and scale management.
Okay, so Refi handles the single asset brilliantly, programming it for that debt-backed efficiency. But, once an investor hits scale, managing a whole portfolio demands something more, right? Institutional level liquidity, which brings us, I think, to REITs real estate investment trusts. This feels like a move up the complexity curve.
It is, definitely. REITs are, well, they're the established institutional answer to portfolio-level liquidity challenges. They offer an exit by bundling a portfolio of cash-flowing properties into a tradable security.
So you're packaging them up.
You're packaging them. For institutional investors or maybe high-net-worth investors, this creates a much more immediate and, frankly, manageable path to liquidity. You're essentially offering fractional ownership.
Right.
And you bypass that expensive, lengthy sale process required if you were trying to sell, dozens of individual properties.
But when we talk about liquidity via REITs, is that always instantaneous? I mean, these sources seem to be discussing pretty specialized exits.
That's a really important nuance, yeah. When our sources discuss REITs as an exit strategy, they're often referring more to the structuring of, say, private REITs or specialized institutional offerings.
Not just buying VNQ on the stock market.
Exactly. Not necessarily the small retail shares on the public market. These are designed for high net worth individuals specifically to liquidate their portfolio stake. It provides a much quicker exit mechanism than trying to sell off the underlying properties one by one.
Okay, that makes sense. And the appeal for the end buyer, the investor in the REITs.
Yeah.
It isn't just that fractional access, right? It's also the reliable payout that's kind of mandated by the structure itself.
Exactly. The structure of a qualifying REIT, it requires it to distribute most of its taxable earnings.
Have to pay it out.
They have to. This ensures pretty consistent cash returns for its investors.
Yeah.
And this reliable distribution mechanism, well, it ensures there's always pretty consistent market demand for the shares, which validates the liquidity of the security, even in, volatile times.
Okay. So if Refi
Mm.
programs the asset for tax efficiency,
Mm.
and REITs program a portfolio for institutional scale,
Yeah.
then tokenization seems like the next logical step, right?
It is?
It programs the asset for, market access and instant liquidity.
Hmm.
This feels like the final stage of that programmable asset vision we started with.
Mm.
And tokenization is, increasingly being viewed as maybe the most transformative exit strategy available in 2025. Quite a claim.
It is a big claim, but this strategy directly confronts the primary challenge in traditional real estate. Its inherent illiquidity. It's just slow to sell.
Always has been.
Always. As one cited economist we looked at emphasizes, tokenization is the disruptive financial innovation that solves real estate's illiquidity problem.
That's a strong statement. Okay, can you walk us through the actual mechanism? How does it work?
Sure. The process involves converting the asset, the property itself, or maybe a defined fractional interest in it, into blockchain-based digital tokens.
Like crypto, but for a building.
Sort of, but tied to a real asset. This concept isn't entirely new. It's already proven in the commodity space. We've seen precedents in digitized gold funds and similar structures. Once it's digitized, that asset is no longer static or restricted to, localized ownership records on some dusty deed.
And the creation of that unprecedented secondary market,
Mm-hmm.
that's where the massive advantages lie for the original investor, right?
Absolutely. I mean, think about the market capabilities this unlocks. You enable potential 2047 global trading with near-instant settlement.
Global reach.
Global reach. It democratizes access and instantly broadens the pool of potential buyers globally, far beyond just your local institutional contacts or your brokerage network.
Okay, that level of access sounds revolutionary, but let me challenge that hyper-liquidity promise for a second. If the fractional token market is, maybe still small or lacks unified global regulation, isn't that theoretical liquidity easily compromised? Is there a risk of just creating illiquid tokens instead of an illiquid property?
That's a critical question. And yes, regulatory clarity is indeed a developing challenge, no doubt. And market depth definitely varies. However, the fundamental advantage, I think, is in the ability to liquidate partial ownership on demand.
The partial piece.
Yes, you avoid that really painful binary choice of selling a whole multi-million-dollar property or selling nothing at all.
Right, it's all or nothing usually.
Usually. With tokenization, you could theoretically sell 5% of your building in an hour if you needed the capital, whereas a traditional property sale takes months. Best case scenario, this dramatically reduces market risk for the original holder.
That ability, selling a fraction of the fraction, that really does feel like the true disruptive element here.
It is. Now, for investors seriously considering this, it's vital to incorporate, let's call it a practicality check.
Yep.
Managing the legal complexities, ensuring regulatory adherence across different borders, handling all the transactional intricacies. It really requires specialized digital platforms and tools. Things designed specifically for this kind of digital disposition. It needs infrastructure to work smoothly.
Got it. So, okay, we've covered the spectrum here. Refi, REITs, tokenization. Now, let's try to distill this into, say, 4 actionable steps you need to take, maybe starting today, to ensure your next investment is truly that programmed asset we talked about, engineered for maximum exit value.
Right. The first, and I think the most foundational, is early liquidity modeling.
Modeling from day one.
From day one, you need to utilize advanced software tools. Tools specifically designed for integrated financial modeling. You have to model the net present value, the NPV.
Right, the current worth of future cash flow.
Exactly. The NPV of a traditional sale versus the NPV of a potential refi to REIT strategy or maybe a tokenization strategy. The goal is continuous optimization for that pre-planned programmed exit.
Okay, step 1, model early. What's step 2?
Step 2. You absolutely must prioritize tax optimization in your planning.
Taxes, always crucial.
Always. This means consulting with specialists, tax advisors, legal counsel to structure the exit right from the beginning. You should be looking to leverage traditional tax-deferred instruments, specifically understanding and, where possible, utilizing 1031 exchange rules for deferred capital gains.
The like-kind exchange.
The like-kind exchange, or strategically using that debt-backed liquidity we discussed with Refi, all with the singular purpose of maximizing the net spendable capital, what actually lands in your bank account, not just the gross sale price on the headline.
Makes sense. Net is what matters.
Okay.
Step 3.
The third step, particularly if you're considering moving into that securitization space, so REIT or tokenization, is compliance and transparency.
Building trust.
Absolutely.
Yeah.
You need to guarantee what the sources call programmable compliance. This means using things like smart contracts.
Self-executing contracts on the blockchain.
Essentially, yes. Self-executing digital agreements that automatically enforce the rules, like specific revenue distributions or maybe voting rights attached to the tokens. This makes the entire fractional structure instantly auditable and trustworthy, which is, frankly, non-negotiable if you want to attract serious institutional capital.
Right. The big money needs that certainty. Okay, that's 3. What's the final step?
And finally, step 4 is timing, market timing.
The crystal ball.
Well, maybe not a crystal ball, but informed timing. You can't just launch a securitized offering or initiate a strategic refi whenever you feel like it and expect optimal results.
Right.
You must try to time market cycles. This involves leveraging proprietary economic analysis, maybe external data, predictive analytics, whatever you can access to align your exit phase precisely with predicted market peaks. And that applies regardless of whether you're selling to an end user, initiating a large refi, or launching a digital token offering.
So plan the exit timing based on data, not just when the renovation's done.
Exactly. The underlying principle we've really been driving toward this whole time is that the exit is not or shouldn't be a hopeful reaction. It should be a planned sequence of steps designed from the outset for maximum value extraction.
This has been a really fascinating journey through realizing those paper gains. We started with Refi, a highly effective mechanism for retaining scale while crucially maximizing tax efficiency. Then we moved to REITs, the more institutional path for fractionalizing large portfolios, getting liquidity at scale.
Right.
And finally, we discussed tokenization, which provides that, well, potential for hyper-liquidity and the really unique ability to liquidate partial assets on demand.
And that leads us, I think, to one final provocative thought for you, the listener, to consider. If real estate, I mean, the most famously illiquid asset class out there, is now being engineered right from the moment of acquisition to be a programmed asset, designed for maximum liquidity extraction, often using digital means, what does that imply for the future of capital markets as a whole?
Interesting question.
Are we moving toward a paradigm where assets are no longer inherently static, but are potentially liquid, or at least partially liquid right from the start? We'd encourage you to explore how this concept of instant partial liquidity might soon revolutionize, well, maybe every other asset class well beyond just real estate.